Hello, everyone. Good afternoon, and welcome to a live stream of a virtual event where we are taking a look at the future of private student lending in the United States. My name is Beth Akers, and I'm a senior fellow at the American Enterprise Institute. I'm joined today by my co-author on a new report on this subject, Preston Cooper, as well as a small group of friends and experts on this issue. So I'm going to talk at you briefly about how we got ourselves into this conversation in the first place. I will pass it then to my co-author Preston to give an overview of the work that we've done in this space. And then we're going to invite what is hopefully a lively conversation moderated by Catherine Knott of Inside Higher Education, Ken Ruggiero, longtime participant in the private side of the higher ed finance space, and Bob Shireman, longtime expert in higher education as well. So to start, myself and Preston have been longtime followers of the private student loan space and supported private sector participation in higher education to agree, but have always been of the mind that there was a role for public sector intervention in higher education finance. So looking back in the past couple of years, we've obviously been had some knee-jerk reactions to some of the actions taken by the administration that didn't fall in line with necessarily the reforms that would have been at the top of our mind. And one day we ended up having a conversation about, what would it look like if in fact we were to have the private sector playing a bigger role in the market for federal student loans? And that's sort of a nice way of putting it, because I think the actual conversation happened over direct messages on Twitter, and we were both feeling a little frustrated that day. But anyway, this exchange turned into what we thought would be a deep exercise in trying to understand what private sector participation in student lending could and should look like. It's often a throwaway line from conservatives that we should get rid of the student loan program altogether and replace it with a private sector financed loan system. That's not always realistic in that most simplest terms, but we thought there are some real questions to ask and to answer in this space. And so that's what we ventured to do in this new report. And so the conversation today will be use that as a jumping off point. Preston will talk to you about some of the issues that we identified and the recommendations that we make in the report. And then we'll bring some more folks into the conversation to talk about, concerns and, different feedback on what it is that we have proposed in the paper. So let me pass it over to you, Preston. You can take it away with more of the meat and potatoes of what it was that we have worked on in this report.
Thanks very much, Beth, for that introduction. I'm going to share my screen here, and hopefully that will work out. Let's see. So I am screen sharing, and I think I need to switch this display. And I think that should work. There we go. So as Beth kind of talked about, we kind of think that there's a lot of problems with the federal student loan program right now. And I don't think it's really an imposition to say, I think that there is bipartisan agreement that there are a lot of problems with the federal student loan program. Of course, there's disagreement about what those problems actually are and what the solutions are. But I think there's a lot of us who feel like the federal student loan program has really gone off the rails. Some of the issues that we see are super high delinquency and default rates. So prior to the pandemic era pause on federal student loan repayments, we expected that over a quarter of students were going to default on their federal student loans at some point in their lifetimes, which is just a huge number, way higher than any other form of consumer debt. And we also see a lot of low quality or scam colleges getting funding. Just a couple of days ago, President Biden canceled $6 billion in student debt for borrowers who had attended the art institutes, which they alleged had defrauded their students among other things. They said that the art institutes had included Serena Williams' salary as part of the average salaries for graduates of the institution, even though that might be just a little bit misleading in terms of the outcomes that the typical student can expect for having gotten a degree there. And the college eventually closed, and a bunch of students were kind of left out in the cold. We also see administrative headaches. The Department of Education has not done a very good job of just administering the student loan program, as anybody who has had to deal with, the administrative troubles in the student loan program can attest. The Department of Education has often not properly counted the number of payments that borrowers have been making towards loan forgiveness programs. Often you're going to be on hold for 2 or 3 hours with your servicer when you're trying to make a simple change. There's a lot of troubles there. We also see enormous fiscal costs. So the most recent Congressional Budget Office projections think that the federal student loan program is going to lose $250 billion. That's billion with a B over a 10-year period. So almost $250 billion, lost on the federal student loan program. And this has also led to a lot of political backlash from both sides. And I think that this has kind of fueled, all these problems have kind of fueled the cancel student debt movement, which really threatens to add, even more fiscal cost to the federal student loan program. And then on the other side of the spectrum, some on the right have called for abolishing the federal student loan program entirely. So people aren't happy, I think it's fair to say. So I'm going to jump into a little bit about the state of the current private student loan market, and then talk a little bit about the merits and drawbacks of privatization before we get into the discussion. So just as a little bit of context, private student loans are a very small share of outstanding student debt today. We know that fewer than 10% of undergraduates at four-year universities actually use private student loans on a year-to-year basis. Contrast that with federal Stafford loans. That's the principal federal student loan program. More than half of undergraduates are using a Stafford loan program. So private student loans are a pretty small part of higher education finance right now. But when we do look at the private student loans that are in existence, we do see some encouraging signs. So this is a comparison of delinquency rates between federal student loan borrowers and private student loan borrowers as of December 2019, the last month before the last quarter, before the pause on student loan payments started. And you can see that students are delinquent on federal loans at 3 times the rate that they're delinquent on private loans. And this actually kind of understates the distress that many federal student loan borrowers may be facing, because this doesn't account for federal student loan safety net programs such as income-driven repayment, and it doesn't account for the people who have defaulted on their student loans and whose loans have been transferred to the collection system. So what is student loan privatization? And now we get a little bit into our, one of the solutions that we kind of want to noodle on a little bit in this discussion. So by privatization, we mean scaling back or eliminating the federal student loan program and allowing the private sector to meet students' financing needs. There's a couple things that we don't mean by privatization. So privatization, in our view, is not federally guaranteed student lending. So some of you may be old enough to recall that before 2010, most federal student loans were actually originated by private banks and then guaranteed by the federal government. And we don't think that this was necessarily a fully private system, because the government, at the end of the day, was still taking on the risk and was still setting the terms of the loans. So a lot of the benefits of privatization, such as, private lenders, taking on the risk and hence making better decisions about what kind of loans to make, really didn't necessarily exist in that old guaranteed student loan regime. We also don't mean selling federal loans to banks. So, some people will suggest that maybe we should just sell off the federal student loan portfolio to Goldman Sachs or something and let them take care of it. We're not here to debate the merits of that, but I think what we mean by privatization is really having a key private role in the origination of loans. So private lenders will be a little bit more discerning about, what kinds of loans they're going to give out. And we also want to note that privatization does not necessarily preclude other federal involvement in higher education. So, privatizing the federal student loan program doesn't really mean touching Pell Grants. We still think that, the Pell Grant program could exist alongside a private student lending regime. This also doesn't preclude, sensible government regulation of the private student loan market. We're simply talking about, the private sector taking the lead in student loan origination, but that doesn't mean the federal government can't intervene in higher education in other ways. So what's the case for privatization? Here's the pro side, and I'll get to the con side in a minute. So right now we see the federal government makes loans mostly without considering the quality of the education on offer or borrowers' ability to repay. There are a few exceptions to that, such as gainful employment, but for the most part, the federal government is basically giving out loans to anybody who wants them to attend basically any accredited college. And this has led to a lot of problems. I mentioned the art institutes earlier, where $6 billion of debt for 317,000 borrowers who basically couldn't repay because the degrees were not really worth anything in the labor market. That's a problem. We think that private lenders would be a bit more reticent to lend to colleges that don't necessarily leave students in a great position to repay their loans. So maybe the art institutes wouldn't find it quite as easy for their students to get loans from the private sector as they would from the federal government. And we think this will steer students towards programs in schools where they're more likely to repay their debts. So maybe you can't get a private loan to go to the art institutes, but maybe you can get a private loan to go somewhere else that might have a little bit of a better track record at actually graduating students and getting them into good middle-class jobs. And this is going to hold colleges accountable for their outcomes in the way the federal government historically has not been able to. If you're going to have to prove to a private lender that your education is actually worth something and that you're charging a reasonable amount for it, that's a much higher bar for the college to meet than the bar they're currently meeting to get access to federal student loans. And I should mention, being good conservatives here at AEI, that privatization will also save hundreds of billions of dollars over 10 years. But we can use those savings to support students in better ways and potentially more targeted ways than student loan subsidies. I also think we do need to engage with some of the problems with privatization that have been raised. So right now, private lenders do depend fairly heavily on FICO scores and cosigners, these kind of traditional measures of creditworthiness. And so there's this very valid concern: could disadvantaged students who might not have a parent who could be a creditworthy cosigner, would they still be able to get financing under a private student lending regime? This does present some access and equity concerns, which we do need to take seriously. I should point out that better methods of making these loans, underwriting these loans, are available. So rather than FICO scores and cosigners, we think in an ideal world, private lenders would make their lending decisions based on the expected financial returns of the education on offer. So they're going to look at, is your college good at placing people into jobs? Is it charging a reasonable price? And are you, as the student, prepared academically to succeed in college and to benefit from that college education? Unfortunately, there are barriers to private lenders actually using these methods of underwriting when they're making loans. So, for instance, the Consumer Financial Protection Bureau, which is the principal financial regulator here at the federal level, has said that underwriting based on outcomes such as student loan default rates could present fair lending concerns and might run afoul of the Equal Credit Opportunity Act. So a lot of private lenders are understandably reticent to use ROI-based underwriting methods because they're worried the CFPB might come down on them like a hammer. And I do want to mention also that kind of disparate impact law, the Equal Credit Opportunity Act, the way that this is played out is it favors older measures of creditworthiness like FICO scores, which have been around forever and have been kind of grandfathered into the system. And so lenders will often fall back on FICO scores and cosigners because these have been around for a while over newer and potentially more effective ways to make lending decisions. I also do want to mention one other potential problem is, what about professions with a lower pay but a high social value, such as teaching? What about the liberal arts? Would these educational pathways, which we consider kind of socially valuable, would they receive adequate financing under a private student lending regime? That's something we have to grapple with as well. So I'm going to close very briefly here by talking about some of the policy options that we discuss in the paper. We're not, recommending a comprehensive policy agenda here, but we do want to submit a couple of options for your consideration. So we think that, if we're talking about privatization, we should really talk about the lowest hanging fruit first. So we think that two types of loans are good candidates for privatization. Number one is federal graduate student loans. If you're a graduate student, you by definition have a bachelor's degree, you've demonstrated your capacity to do work at a post-secondary level. You've probably been in the labor force for a few years. You probably have a credit history and income history that would make it a lot easier for you to get a private loan. We think that the federal graduate student loan market is an obvious place to start for privatization. And another obvious place to start is federal loans to parents of undergraduates. Parents of undergraduates, to get a federal loan, they already have to pass a basic credit check. And the federal student loan program actually makes a profit on parents because parents are charged very high interest rates, very high origination fees. And so the private sector could actually come in and offer parents better rates on their loans and still make a profit relative to what the federal government is charging. But if you want to go a little bit further and say, I don't want to stop with graduate students and parents, I want to privatize the whole student loan program, we think that there are a few additional things you could consider. Regulatory reform is an obvious candidate. We have submitted the option of potentially a safe harbor for lenders to use ROI-based methods to underwrite and make student lending decisions. So, if you're a private lender and you want to lend based on default rates or expected debt-to-income ratios or completion rates or all of these other factors that have to do with the financial value of higher education, we think that, some protections for those lenders may be in order. Also, if you were to privatize the entire federal student loan program, you would have a lot of savings to play with, $250 billion. And so we submit that potentially policymakers could consider larger Pell Grants in order to reduce lower and middle income students' need to borrow and potentially solve some of those access and equity concerns that could be brought about by the end of federal student lending. And we also want to say briefly at the end here, for those public service professions, people who are, in jobs that we think are socially valuable but might not pay a whole lot. We think that those jobs are too heavily credentialed as it is. So for teachers are a great example. A lot of states will either require or encourage teachers to get master's degrees. And there's not a whole lot of evidence that, getting a master's degree really makes you a better teacher. So potentially one solution here would be for states to reduce credential requirements for public service professions. And the federal government can also help here. Rather than subsidizing the education that people are getting, why not just support those workers directly, potentially through a tax credit? Moving forward, I want to leave you with a few small takeaways before I turn things over to Catherine for moderation. We do need to fix the student loan program going forward rather than just forgiving past loans, because if we don't make reforms going forward, we're just going to be right back in this situation 5 years from now with potentially more demand for student loan cancellation. I want to mention that, privatization is a solution that should be on the table. It can address many of the problems that we do see in federal student lending, and especially those high fiscal costs and the low returns that students are often getting for their education. But we should be cautious when we're considering privatization. We don't necessarily just want to bring back the old guaranteed student loan program. And we also think that if you're going, all the way and you want to fully privatize the federal student loan program, you should consider other policy options as well. Regulatory reform is an obvious candidate, and also potentially modest expansions of grant aid. And done right, privatization is something that really can change higher education for the better. We think that it's definitely an idea worth considering, but we think that it's not just as simple as pressing the big red button and abolishing the federal student loan program. There are a lot of other considerations that we should take into account if we're going to go down that path. So that's pretty much all I have for you on this. Trying to figure out how to stop my screen share. There we go. Right now, I'll turn it over to Catherine Knott, who is an excellent reporter at Inside Higher Education, focusing on federal policy. I read her stuff every morning in the Inside Higher Ed newsletter. She's awesome at covering this. And yeah, I'll stop talking now, and Catherine, take it away.
Awesome. Thanks so much for the introduction, Preston. Glad to know you're a daily reader of Inside Higher Ed. Hello, everyone. I'm Catherine Knott, and as Preston and Beth mentioned, I work at Inside Higher Ed, where I cover federal policy. So that's everything from whatever's happening on the Hill, new regulatory actions, debt relief. It's very busy time right now to be on the federal policy beat in DC. We got a great panel today. You've already met Beth and Preston. As Beth noted, we also have Ken and Bob with us today, and I'm going to have them introduce themselves and share a little bit about what brings them to the panel today, and then we'll get going. Ken, want to kick us off?
Thanks, Catherine, and thanks for the invite, everyone. My name is Ken Ruggiero. I am the co-founder and CEO of Ascent. And I also have a background as the leader of a FEL originator called Gold Financials. So I have a lot of experience in the FEL program back in the day, and now the new program at Ascent. We are a student success company that offers student loans, and we offer this success program and funding at 2,400 Title IV schools, both undergraduate and graduate. And we provide loans for families or students who don't have a co-signer. We finance DACA students, temporary protected status students, international students attending Title IV institutions. We also fund over 1,800 programs in non-Title IV schools. So think the welding, HVAC repair, coding boot camps. We work with many providers helping adult learners find short duration programs into the workforce. And we wrap all of that in the Ascent Up student success platform, which helps them with durable skills and then entrance into the workforce, the skills they need to start a job, get through school and start a job, with digital mentoring and on-staff college coaches.
Awesome. Bob, how about you?
I'm Bob Shireman. I am a senior fellow at the Century Foundation. I've been involved in student loan issues ever since the Senator Sam Nunn's permanent subcommittee hearings in investigation into student loan fraud and abuse in 1989. So a long time. Origination of the first income contingent loan program in 1992. And served in the Clinton and Obama administrations, and now at the Century Foundation, where we work on education, on education, healthcare, labor, and other issues.
Excellent. So, Preston, you talked about this in your presentation, but just so that we're all very clear, what kind of private loans are you talking about? Like, what is different between what you guys are talking about in the paper and FEL, for those who are still a little confused?
That's a great question. So, the old FEL loan program, it was still a federal loan program. Basically, what would happen is private banks would originate loans. The terms of those loans would be set by the federal government. So loan limits, eligibility, interest rates, and so forth, that would all be set by the federal government. And the federal government would also guarantee the loans. So if students defaulted on the loans or were otherwise unable to pay them back, then the federal government would, for the most part, make those lenders whole. And so, no shade on Ken here. There's there are the merits and drawbacks to the FEL program, but it's really not what we're talking about here when we talk about the truly private regime of student lending. And I think for a truly private regime of student lending, we want the private lenders to actually take on the risk as well as not the federal government. Mm-hmm. And for the private lenders to actually set the terms of the loan, set interest rates, determine eligibility, and so forth, because we think that if they're taking on that risk, they'll be making better decisions.
Yeah, that's good to know.
Catherine, can I interject? And then I promise I will let some of our guests speak as well. But the reason that this is something that we highlight in the paper is because I think this is a common misconception, that FEL was the golden age of private student lending. We often hear lawmakers conjure that sentiment during hearings on the Hill, and it's really just not accurate. And I think it's kind of derailed the conversation about privatization of student lending. So I just wanted to throw that out there, and then I'll stop interjecting and let our friends talk too.
Yeah, and just Ken, you called yourself a student success company that gives out student loans. Briefly, just tell us a little bit more about what you do and how you consider a student success, because I feel like that's maybe not as what people would think about when it comes to private student lending.
Yeah. We started the business because we weren't a bank and we weren't a government or a philanthropic, and we really said, what do students need to be successful in their journey? And we were lending initially to students who didn't have a co-signer. So you needed to build a different business to accommodate that. So we have financial literacy and financial wellness training at the point of sale. So no one gets a loan from Ascent unless they've gone through a test and then training, and then they have to retake the assessment to make sure they understand what they're about to do before they actually get the money. And then when they graduate, we bring them back into offboarding as well to explain to them what their options are and what the difference between a federal and a private student loan is. Over time, we've built other support systems. So during the origination process, we ask them one question. We go, what's causing you the most stress right now? And every student has stress. So we use that answer, and it usually falls into academics, job readiness or job search, or financials and financial management. So we use that for our digital videos and push notifications on content, or our staff coaches who can start to help people. The students get stuck for different reasons over different periods of time. And we've learned through doing this that if you unstick them fast, then they stay on the journey. If they stay stuck long, like nothing good happens when it stops moving in higher ed and learning. So,
Cool.
so we do all of that. And then we announced this week, we announced our internship program. So the best way to like get a student to pay back their loan is to get them a job. So we're doing paid internships now. It just went live this week, where our learners are being offered, the training to get ready for an internship, and then we're matching them to paid internships in the labor market. So we've been busy.
Sounds like a lot going on. Yeah.
Yeah. Thank you.
So now that we got that grounding, let's get a little bit more context. I mean, as Preston in the presentation noted, where the federal government's role in student loans has expanded significantly, and student loan reform is obviously a big issue in Washington right now. I think the Biden administration's up to 160 billion maybe for what 4.6 million borrowers in relief. Bob, why is the federal government so involved in student lending, and what does it kind of say? What does this conversation today say about the state of higher ed financing?
Right, thank you. Well, I think it's important to recognize that in general, loans are not a good way to fund higher education. It used to be that financial aid administrators would say, well, it's a good kind of loan because, it helps you to finance some future income. But yes, there are historically positive returns on average for graduates of college. But when you enroll in college as a student, you may or may not graduate. Half of students don't. You probably will change your major from what you thought in the beginning. You maybe thought, oh, I'm going to go to med school, major in biology. You take chemistry. It doesn't go well. You end up with a different major. You may or may not get the job that you had planned for if you graduate. And the wages in the economy may look very different from wages in the economy right now. So much like the stock market, there's historical evidence that it's a good investment, but we do not encourage people to borrow money to invest in the stock market. And college, in that sense, is even worse because it's not even a diversified portfolio. You're investing in one stock. So that's why the federal government has gotten involved in student loans. And more importantly, it's why I and others have worked so hard to make sure that there is a good safety net on student loans, that if your earnings don't end up being as high as hoped for, or as high as maybe we hope for in the economy, that there's a safety net based on income. I've come to realize that most of the problems that we've seen, some of them have to do with the design of income-based repayment, but a lot of it has to do with the administration of it. The fact that the government needs to go through so many hoops to figure out what your income was, and it all happens afterwards instead of at the time that you're earning income. So I think that we can do a better job with safety nets on the safety net on student loans, and I think going too far in eliminating the federal student loan program without providing massive amounts of grant aid would push too many people of low and middle income backgrounds into private loans that don't have an adequate safety net.
So you're a fan of the idea of privatization of student loans?
Well, so I think I would agree that the federal student loan program, especially in the graduate loan area, has flooded the market with easy money for colleges. There is no limit on how much a college can charge for tuition in the student loan program, and unlimited federal loans in the graduate loan program. And this has led to a situation where colleges have an incentive to create new programs that are very low cost to deliver, and to basically make it seem like everybody needs to have a graduate degree in this and that. And there's the report mentions the problem of credentialism, and I think it has contributed to some of the credentialism in the on the graduate side of things. And I would agree that it would be useful that we need to ramp back. We need to rein in the amount of loans that we're making available. A good place to start would be at the graduate school level. I would actually do it somewhat differently. People tend to think of, no, oh, we need to have a loan limit or something like that. I actually think it would be useful to provide colleges with an allocation, a total allocation of grant and loan aid that they can put toward the students who they feel don't have family or business connections to help finance their education, to reduce the hazard of completely pulling back from the student loan market. And that would also change the incentives for the colleges, where they won't be feeling like, oh, the way to bring in more money to subsidize other things is to just keep expanding graduate loan programs and creating new low-cost loan programs. Instead, it tells them, you have a bunch of grant aid and some loan allocations. Use that in a judicious way for the students who need it, and then yes, bring in the private market to the extent that other support is needed.
Definitely. I'm glad you brought up graduate student loans, because it was one of the areas you guys have mentioned. It is ripe for, it's a good candidate for privatization. And graduate student loans have obviously been in the ether and the discussion, as they make up nearly half of the federal government's loan portfolio. Why? I mean, what makes graduate student loans a better candidate than like an undergraduate loan?
Well, I'd say
I can jump in on that one.
You want to go ahead?
Sorry, go ahead, Bob.
Well,
Well,
graduate loans have the unlimited loan limit. The grad plus is unlimited and goes to the students. There is plus or parent loan programs at the undergraduate level, but it hasn't dominated quite as much. There needs to be reforms also with plus, the parent loan program at the undergraduate level. But also what you have going on with the graduate loans is they're money makers for other parts of the college. And so you have more evidence of price effects from the graduate plus loans than the undergraduate loans, where generally there's a limit on the amount of Stafford loans at the undergraduate level.
Definitely. Beth, you want to get in?
Yeah, from our perspective too, I think that, some people are worried. Some people like Bob are worried about the role of private student loans and students potentially becoming victims of private sector participation, bad actors that could emerge if we allow this sector to grow. And I think that those concerns are somewhat tempered when we're looking at the graduate student population. This is already a population that has undergraduate degree and has demonstrated, a level of achievement in academics that I think makes us a little bit more confident that they'd be able to navigate. And I think that incremental policy change is often good because we can test the waters and pull back and scale up as we go. And so this is a community that I think we can learn from. If we, were to, dabble in privatization, this is a comfortable place for me to start.
Got it. Switching gears a little bit, because I found so compelling in the report, was the idea of how this connects to accountability and driving a lot of the big changes that I think policymakers on both sides of the aisle want to see right now, in terms of students getting a bit better, students and taxpayers kind of getting a bit better bang for their buck. I mean, why is private student lending the lever to pull on when we're talking about trying to improve outcomes and holding institutions accountable? It's for the group, but Ken, you want to kick us off?
Yeah. I guess one thing, back to Bob's comment, I think he found a way to thread the ground rules needle on this one, Preston, because it sounded like what his proposal was, it rhymed with Perkins. But I'm not sure. I'll need a separate ruling on that one. But so I like data and context. So part of the answer to your question, Catherine, I think we can go back in time and say, when the private sector was lending to graduate schools, when the FEL business existed, what happened from a volume perspective when the Grad Plus loan came in? And so by our math, there was about $3 billion of private student loans going to graduate school students back in 2006. So everyone marinate, and now go to today and say how many graduate school loans, not the grad Stafford, but the grad plus. If we just focus on that one, what volume is being done there? And it's in the tens of billions of dollars, right? So you're like, wow, when the private sector had some level of say in what would it fund, what was expected to get paid back. And this just highlights the point of some of the moral hazard. When you remove any level of accountability in a lending program, nothing good happens, and it actually rewards and incents the actors who are receiving the money. Remember, the schools get the money on day one, the lenders get it over 10 years. So we're incented to make sure that the longevity of the learning and the occupation is rewarding to us and the student. And you only get like 10% interest rate. So there's a lot of risk at 10 years of money. So the price controls, if you will, that took place back in the day were removed. And now we've seen how the schools behaved. So we don't need any more data to realize that the schools have increased the price of the education, increased the number of programs that aren't a good investment. And this was working, I'll say pretty well in partnership with the federal program. And so lenders are always going to look at FICO first when it comes to lending, and it rank orders. It is a very, very good tool to use to calculate the cost of and availability of credit. But as we've seen, when someone either doesn't have credit or they have a credit score and no job, you need to look at other instances like the ones that we've talked about today, like the labor market, like the quality of the education, like the quality of the institution, like the duration of the program. We don't need to go down, but like when you look at the length of some of these programs, it just puts more risk into the outcome. I think we have the tools, and now we have more data than we ever had. Back in 2006, the college scorecard didn't exist. We have great data now. Everyone does, where we can see the good and the bad actors. We don't need the gainful employment look back score. I mean, those things are good tools too in the right application, but like we've got good data to sort this one out in partnership or individually like we're doing right now.
Ken, what's the safety net for borrowers if like you and the borrowers like make a bad bet on an institution? I mean, it still seems like the risk falls on the student in that case.
Yeah, I think there's a couple. I'll start with like the structure for a safety net. At Ascent, we've studied the data, and all of our loans for undergraduate and graduate, like undergraduate loans all come with 9 months of grace. So why would we wait 9 months to collect? Well, because it's better while people are getting into the workforce and incurring first time job startup costs. They just pay their loans back more than 6 months grace. And so the federal government's still at 6 months. Bob, if you could call someone in DC, get them to move it to 9 months. I'll show you the data. It works. So that's one. Two, we have a lot of forms of we don't use income-based repayment. We just let people show us that they're struggling, and they can get up to 3 years of forbearance on their loans, but they have to talk to the servicer. They have to tell us that there's problems. And what the data says is if you give people time and space, as long as they're communicating, you can get them back on side of a private student loan. And that's very, very different than set it and forget it IBR or ICR. Like that, a lot of the issues are that there isn't a conversation going on, and people are losing sight of a very complex set of obligations. So the private sector has been figuring how to safely provide loans. Now, specific to your point, Catherine, when someone made a bad decision, well, the way credit works is some people make a good decision and pay back their loans, and they bear the cost of that when someone makes either a bad decision or has a bad thing happen to them. So credit works to charge the people who are going to be successful a little bit more than what they otherwise would pay if everyone took the same loan of known success. And that helps us manage the costs of those who can't pay it back.
Yeah, I mean, I guess the point is in the federal system right now, there are other levers if the schools aren't doing what they need to be doing with the Title IV hook and things like that. I mean, Bob, you helped to write Gainful years ago, didn't you? What do you think of these arguments?
Well, I do think that there's a benefit to having some private sector accountability. It's hard for students to assess school quality, and having other folks who have a business that involves looking at school quality can be helpful. It really was the original idea behind having guaranteed student loans in the 1960s. Much as was pointed out in the report, and I think this was important, when it's a government program, the Congress can't resist just kind of continuing to sweeten it up. And so we ended up with the lenders really having no real underwriting at all. And so they were not really looking at issues of school quality. And the guarantee agencies were supposed to do that as well. And for the same reason, it didn't happen. So finding a way that we can bring some of that into higher education, I think would be useful. The major downside I think we really need to think seriously about has to do with the fact that wealth in this country is very correlated with race. And things like credit scores tend to reflect some of that. And we very well could have schools and students who are being denied or who have a higher interest rate essentially because of their race. It's not explicit on race, but it's heavily leans in the direction of race. And that's why it's critically important to include in any reform substantial additional grant aid and some kind of additional loan authority, so that we have additional Stafford loans in some circumstances at some schools.
Definitely. So, Beth and Preston, for whoever wants it, with the privatized student loan market that you're envisioning, how do you ensure that those who need the money have access to it to kind of ensure that, kind of what Bob's talking about, the people that, would benefit from higher ed can still reap those rewards?
Well, I think we definitely, one of the big things we found in our paper is it's important to move away from the traditional measures of creditworthiness that private lenders have often relied upon. FICO scores might be great for assessing a mortgage or a car loan, but it's not necessarily the best tool to use when you're talking about a student loan. And that's why I think the industry, it would be beneficial to move towards more ROI based methods of underwriting, to look at, is this student, one, academically prepared to succeed in college? Are they going to an institution that is charging a reasonable price for the value they're offering? Are they choosing a field of study, a course of study that is likely to lead to a decent labor market outcome? If you have that kind of framework for deciding who's going to get a loan, that doesn't necessarily that's not necessarily something that's you're going to have the inequity effects of a FICO score. Obviously, there's differences in who has access to which college and what an academic preparation along a lot of socioeconomic dimensions. But I do think that moving towards a world in which we are underwriting based more on ROI would have some positive equity effects. And again, I would be supportive of using some of the savings from privatizing federal student loans to expand grant aid for lower and middle income students in a targeted way.
Yeah. I will say we'll be moving to the Q&A portion shortly. We've already been getting some great questions. So if you have them, send them along. Not the panelist. You don't get questions. One thing I just was thinking about, there are so many different ways out there to measure return on investment and economic value. This has been a conversation among the DC policy community for years now. How would we be giving private student lenders a little too much power, and that they would then be the arbiters of ROI? Or would we need a national framework for an ROI that everyone can agree upon in kind of this system?
I think you
go ahead.
Go ahead, Ken. No, please go ahead.
No, I've struggled with this one for literally decades because we've always wanted to try and simplify the conversation for a family, especially people who aren't used to they don't know how to spell ROI, right? It's a very complicated equation and Preston, you've done work on ROI, so I guess I should let you go first. I guess I think you have to really simplify it, and we try to do that for the families, and And like we have a rule of thumb, and don't shame me on this one, Preston, because you did all the math and it's good math. Is like, hey, if your expected starting salary for the school and the major you're going to is equal to or less than the tuition, like just think like that maybe that seems reasonable. But if it's a multiple of the tuition, then maybe you should pause. Now I'll pass the mic to Preston because like he did all the math, and he can definitely make this much more complicated. But that we've been talking to families in that manner, and it's driving more productive conversations. I can't put that into policy, Catherine. Sorry.
But if I can weigh in a little bit here, one thing that I think would be, college is complicated, borrowing for college is complicated. All of these data are impossible for anyone to really understand and to figure out how it applies to their own life. Very difficult for the average somebody with above average background in this area. One thing I think is worth trying is a system of third-party counseling pre-enrollment, a way that people could have a conversation with someone who does not have a financial interest. It's not somebody at the college, so it's not like this, oh, to get my loan money I need to do this video. It's instead somebody who's helping to understand those questions of what do the data say about future earnings. Do I have the kind of background that's relevant to the data? Things like that I think some third-party advising could be helpful with. I don't know how well it would work, but I think it could help in some of these situations.
Mm-hmm. Preston, anything to add?
Sure. Yeah, no, I'll just say, on the accountability front, the federal government's primary accountability tool historically for the student loan program has been the cohort default rate. And, back in the late 80s, early 90s, when the cohort default rate was established, this is like what percentage of students are defaulting on their loans. This is actually a decent signal of quality. There are a lot of fly-by-night scam institutions which lost eligibility for federal student loans under the cohort default rate, back then. And a lot of students were protected from taking out loans that they shouldn't have. Unfortunately, over time, colleges found ways to avoid the cohort default rate by putting people in forbearance and so forth. And we had to start looking for new accountability tools. But, as we all know, the federal government is often, very slow to respond to those developments, very slow to develop new accountability tools. So we're kind of back in a similar situation where a lot of students are taking out loans that they really shouldn't be, and attending colleges that are just not a great value. Because the federal government hasn't been able to keep up with the accountability conversation. And that's where I feel the private sector could really add some value, because the private sector, they've got their own money on the line. They're going to be much more reactive to these developments in the thinking about what sorts of measurements are more effective at showing financial value. And they're probably going to move on from cohort default rate much sooner than the federal government did.
Yeah, I mean, I'll note the pandemic pause has basically made cohort default rate meaningless, and so will the new income-driven repayment program, the new plan saved. So, and I think there's been a lot of calls for something else other than cohort default rate. And I feel like the federal government or the Biden administration would say that's what Gainful's for. Anywho, we've got a lot of fun questions to get to. Really, just quickly, what options are there for state policy in this space, or is this just a federal issue? I know they're the ones making loans, but that's the question.
When states have come to me for advice, usually they're looking for a way that they can start a loan program and make some money off of it. and my advice is, please don't. We've had some really bad examples of those in various states. I do think on oversight of colleges and universities, especially some of the private and for-profit schools that have been a problem, that states have historically had an important role there and could be doing more than they're doing. And California has some rules regarding private student loans that that I think are probably worth looking at. Probably some other states do as well. I'm not an expert on what's out there.
I'll add to that too. I think, we're kind of moving against the direction of these income based repaid private student loans. Though we had a bit of a wave of those back when Purdue started back a boiler and the income share agreement model was more popular. But there is a role for states in that space, which is to provide some regulatory clarity around those loans. I, for one, would love to see some expansion of that market. I think the impediments at the moment are at the federal level, but under a new administration, I think that there would be a demand for states to offer more clarity to allow that marketplace to expand.
Definitely.
I will tell you one thing that we launched in Colorado. This isn't in Title IV, but the state of Colorado wanted more technical skills, so we helped them launch it's a 0% interest rate loan that only goes into repayment if the student gets a job over 40 grand. And then they know the monthly payment before, so it's not bouncing around by income, and they can afford 40 grand if they get an entry-level tech job. So we have taken some of that income share agreement technology, and you can forecast the starting salary with which is they'll have enough disposable income, and it removes some of the look back or look forward complexity of setting a variable payment on an annual basis.
Definitely. One of the other questions we got from the audience is, what about the liberal arts? I know it came up in the presentation, and you guys had some strong words about the current state of liberal arts and how the current system is serving them in your paper. So does empowering the private sector mean liberal arts programs will see fewer students and will die a slow, painful death, for lack of a better phrase?
Strong words. No, that must have misread, or you must have misread. Preston and I have written about this notion in a few different places where we just tend to believe that the student lending program is the wrong place to be subsidizing things that are not self-sustaining through the marketplace. So some liberal arts programs offer fantastic return on investment. Those places will continue to thrive. Although there are others that students are not having great employment success after they finish, and moving towards privatization would, of course, put pressure on those institutions because they'd have a harder time finding financing. I think we need to step back and say, what are the things that we as a society value, and put money directly towards those things rather than trying to sort of use a backdoor through the student lending program to make sure that they continue to exist. Things like, Preston talked about teachers in his presentation, social workers. These are often jobs that are government jobs. We could just pay them more. And that would function as a subsidy that's a lot more efficient than going through the lending program. So in the case of liberal arts, do we think as a society that liberal arts is important beyond the places in which liberal arts offers a fantastic return on investment? I'm not sure. I don't think I'm an expert on that, but I think that's one that we could kick to lawmakers to decide. And if they decide that it is, there's money that comes from the savings of privatization that we could put towards that in a more direct and explicit manner. And I guess that's the policy regime that I think Preston would also like to move towards.
I'll agree we should increase wages. Many people with liberal arts degrees do very well. I mean, I think there's an overemphasis on that being some kind of a problem to major in the liberal arts, when generally the kind of critical thinking that's demonstrated by liberal arts graduates is something that many well-paying employers are really looking for. And so we shouldn't assume that it is a problem. I think providing some general grant aid and Perkins-like loans, if you want to call it that, to colleges gives them the ability to decide that they can put some of that toward programs that tend to prepare teachers, or finance, or keeping public service loan forgiveness on those loans so that it continues to be available. It's also one of the reasons that I think graduate loans are a good place to start because you have fewer of those issues there. We can see how reining in some of the federal student loan programs excess is there. We can see what some of the impacts are in an area that tends to be more occupation oriented and more in the high earnings area.
Yeah, and I'm just going to jump in on last point as one, I have to say every time this topic comes up, the Ascent General Counsel always says I graduated with an art history major. So I think that's kind of funny because he's an amazing lawyer. But an art history major from a nonprofit liberal arts college that charges $90,000 a year for art history is very different than a San Diego State art history major. So I think we have a cost conversation, not a major conversation. You can get art history in a lot of different places. And so like, if you want to be like, you just need to make a right purchase decision before you make the right major decision. And we see people make those wrong decisions all the time. And those are the stories that we talk about.
Wonderful. I'm going to try to squeeze in 3 questions, so we'll keep it short and quick. What do you all say I'll start to Beth or Preston, to critics that worry about predatory loans in the private sector?
Yeah, well, I mean, I don't think that a private student lending regime, precludes sensible regulation. We have private sector involvement in other areas of consumer credit, home loans, auto loans, and I think we should apply, some of the same consumer protections there to federal student loans. And I would point out that federal student loans are often more predatory than private mortgages, because at least with the mortgage, you have to have a disclosure saying, what you're borrowing, what your monthly payment is, what your interest rate is. That's not really applicable to federal student loans. So yes, let's have a more regulated private student loan market because it'll be more consumer protected than the feds.
Definitely. And what was so wrong with FEL? Why do you all feel so strongly that we shouldn't go back to that model?
Take this. Oh, is this for me? FEL was not a private student loan. I mean, we're talking about the value of private underwriting. The private lenders have the incentive to figure out who can afford to pay back their loan and how much they can afford to pay it back. And then they make credit available on those terms. When we take away that privilege from them, then it's no longer a private student loan. It doesn't offer any of the advantages that we think are going to get us to a better place.
Perfect. Look, we got through 2 questions so quickly. So thinking about where do we go from here, are there any Democrats on the Hill seriously considering these proposed reforms? Have you heard more talk from the Republicans? Like, I know you guys wrote this whole big paper. Do you think there's a chance it becomes policy? For whoever wants it.
I think there's definite interest in the explosive growth of graduate student loan debt in particular. And in doing something about that, and the fact that it is now more of a coster than a saver, no longer making the federal government money, puts it looks different now to Congress, and so there might be some interest there on the Democratic side, and probably some on the Republican side. There are concerns about impacts on access. The universities, some of the universities will be concerned about changes, but it seems like a potential area for bipartisan work. I do want to mention one thing. We didn't mention bankruptcy, and there was some discussion of bankruptcy in the paper. And we really do need to, for private student loans, make them just like other loans and not subject to the undue hardship level of for treatment. That would help a little bit anyway on some of the safety net side of things.
Definitely. So we got 2 minutes left as we ran through our rapid fire questions. Closing thoughts from the panel about next steps and things to ponder so everyone can get on their evening at 5 o'clock on a Friday.
Yeah, well, I mean, I would just, submit that this can be the first stage of a conversation about, scaling back or potentially eliminating the federal student loan program. I think part of the reason that Beth and I wrote this paper in the first place is that it is often a throwaway line for conservatives, for Republicans, that, oh, we should just, get rid of the federal student loan program. And so I think we want to take that a bit more seriously and say, well, what does that actually mean? What would that look like? What would some of the other policy changes be needed to actually make that a reality? And so, I don't think that our paper should be the last word on this. I'm sure that other people will come along with other great ideas about, how private student lending a system could work and should work. And I look forward to continuing the conversation.
And I'll just say I really appreciate the thoughtful paper and good discussion.
Yeah, and you said any thought-provoking idea. Bob started his initial comments with saying it's hard to predict an outcome to a freshman who hasn't picked a major and maybe they picked the wrong school or wrong location for a school. I think there's an opportunity to like double the Pell in the first 2 years, and then make the Pell 0 in the last 2 years. And so if you allow the private sector to come in and start lending like alongside or in place of the federal government, we can price the credit within 24 months of graduation much more accurately. And to the extent that the credit's not a good decision, then maybe Bob's idea about like, hey, the school can allocate their own capital to continue a process, but we can get more people into education by making it cheaper in the first 2 years and lower risk. It's going to be a default anyway, so let's just make it a grant in the first 2 years or a partial grant, and then in the last 2 years let us come in. I'll take senior year. The private sector can underwrite every senior in the country and open up access to credit, and then let the schools finish the last mile. So I think there's a lot of ideas using existing ingredients and some of the old recipes. And I love having this conversation about holding schools accountable for outcomes. Please, Bob, make the Title IV schools accountable and disclosable for all outcomes. That would be a wonderful world.
What a great place to end. Thank you all so much for joining us tonight, and have a great rest of your weekend.
Thank you, everyone.
Thanks, everyone.